The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
For a market that runs on narratives, no one really seems to know where this story is going to go next. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Now on Friday, good jobs data was good news for stocks. Today, the market is reassessing that conclusion. The S&P 500 and stocks overall in retreat mode. We're actually at session lows, and it's notable here that the S&P has not managed to string together 2 straight days of gains or losses in about 2 weeks. The 10-year yield topping 4%. That is the first time since August. There's a lot of supply coming on this week. We had 3-month and 6-month bills today. There's a 3-year and 10-year auction later on this week. And NYMEX crude continues to move higher. This is now the 5th straight day of gains here as WTI approaches $78 a barrel. And we should note Chinese stocks continue to build on their momentum, the recent momentum, while the mainland markets are closed today following last week's or 2 weeks ago's big stimulus package.
All right, but let's go back to that second line of your screen. 4% and change right now on a 10-year yield. That sound you're hearing, that's the sound of the bond market today of capitulation. Open interest in Treasury futures right now are down across multiple contracts linked to overnight financing rates, and that is a bet that another jumbo Fed rate cut might just be a pipe dream at this point. Options traders really trying to front run that right now with the prospect of fresh hawkish hedges targeting just 1/4 point rate cut in total for the rest of the year.
We think that we are not too far away from the monetary policy stance currently being close to neutral. So if that's the case, we don't need a dramatic amount of Fed cuts.
And of course, Thorsten Slock has already been down that road. Citigroup economists now finally getting the message, becoming the last major Wall Street bank to abandon calls for a 0.5 point cut at the Fed's November meeting. Citi strategists, along with Bank of America and J.P. Morgan, now modeling for higher yields. J.P. Morgan and Morgan Stanley throwing in the towel on curve steepener recommendations as the 2-year, 10-year curve, which has been steepening for more than a month, briefly dipped back into inversion just about before 7 a.m. Eastern time today. Meanwhile, you have a slight upward shift for the oil curve as traders reposition around the prospect for short-term supply disruptions. That's partly because of those reverberations from interest rate bets, partly from the military conflict in the Middle East, and partly from disruptions from Hurricane Milton. Brent crude right now soaring back above $80 a barrel for the first time since August, while WTI's second-month calls right now, Scarlett, trading at the biggest premium to put since March of 2022.
Yeah, but I want to go back to the capitulation that we see in the bond market here, because really when it comes down to it, the reason why markets are feverishly repricing a less dovish Fed is because of better economic data capped off by last Friday's blockbuster jobs report. So this chart tracks economic surprises. The blue line covers the labor market data points. The white line covers that and other data points, including housing, as well as manufacturing as well. And what you'll see is that both indexes were at 2-year lows not so long ago before shooting up. Notably, this month, there's that straight line up, a reflection of how reports are coming in better than economists had anticipated. Increasingly, bond investors are looking at the Fed possibly pulling off a no-landing scenario with a possible reignition of inflation.
All right, well, let's kick things off with someone who knows this market better than anyone. Kathy Jones is Chief Fixed Income Strategist with the Schwab Center for Financial Research, and she joins us right now in Studio 2 to kick us off to the close. Great to see you, Kathy.
Good to see you, Roman.
And a great day to have you, given the moves that we've been seeing in the Treasury space, not just today, but really over the last few days. And kind of interesting, too, coming out of that big Fed meeting where we did get that jumbo cut, there didn't ever really seem to be a ton of conviction that we were going to get additional jumbo cuts, despite what the swaps market was trying to tell us.
Yeah, I think that what we've seen in this cycle is just a number of surprises and twists and turns, because we haven't had a pandemic cycle in our lifetime. Mm-hmm. And so every time we think we've caught the direction, it changes course. But the underlying trend is a pretty healthy economy defying gravity, despite all the constraints that have been thrown at it with, tight monetary policy, weak global growth, wars and conflicts around the globe, and consumer sentiment being really poor, and yet consumers spend money because they have jobs.
Well, And that's a great point, too. I mean, despite all the hand-wringing about that jobs report, I thought it was a relatively encouraging report. Now, I understand for certain traders who were positioned a certain way, it caught them off guard. But it raises the question as to where yields go. Are we looking at big directional changes, either up or down, or should investors maybe prepare for this idea that we could just kind of be in kind of this range-bound area, given what you said about the economy?
Yeah, we think range-bound. So we had for a long time about 375, 380 as a fair value on the 10-year. Now, markets don't trade at fair value all the time. Yeah. So you expect a trade around that. But directionally, in order to get further down, you really would have needed confirmation from much weaker economic data, especially the jobs data. And we didn't get that. We have the inflation numbers going in the right direction. And I think it's wrong to assume that just because we have growth, we're going to get inflation. Not all growth is inflationary. But it does mean we're sort of range bound here, I would say, between, maybe 360 on the downside and 410, 415 on the upside in the 10-year.
I like what you said about that. Not all growth is inflationary, yet that's the thinking that if we get a no landing scenario, inflation is kind of inevitable. What kind of growth are we in for if it's not inflationary?
Well, we've had really a big increase in productivity, and that's just output per unit of labor input. And so what we've seen is goods prices have come down. And service sector prices are kind of leveling off. And the labor market's probably in good balance right now. It's not accelerating to the point where we're seeing big wage gains and big shortages of workers. So we're kind of in balance here. But if you get productivity growth, you can grow at a faster rate without inflation. And that's kind of a Goldilocks, never land, a world that you don't see very often, but it's the world we've been in now for quite a while.
And you think that's going to show up in this week's CPI and PPI reports as well?
Yeah, we do think we'll see some soft numbers there, maybe 0.1% on the CPI overall, and that continues. The 3-month and 6-month rate of change numbers continue to come down really pretty fast. So we are encouraged about inflation, and that's probably going to cap yields. But as long as growth is strong, they're not going to fall too much.
When we talk about the state of the economy, and particularly what's been going on with interest rates, there's been a lot of focus on the bond market, the public bond markets, I should say. I am curious about corporate debt and whether we're going to see a more attractive environment, particularly for the less than stellar names that I think a lot of people had avoided for most of the year.
Yeah, the high yield sub-investment grade market, bank loan, have done very well. Those spreads are very tight, and that's partly because we've been in a sort of benign environment. So even though the lowest quality credits are defaulting at a higher rate, it's not exorbitant, and the yield has been so high that they've been able to continue to sell their bonds or to have people hold on to their bonds. They've also done something called distressed exchanges. So before they default, they just do a workout ahead of time. Now, if you were holding the bond at par, that doesn't do you any good.
Right.
But for some people, that's a way to avoid the default rate going up. So I'm still a little bit cautious because valuations are so high for the lower part of the high yield market. I'd be a little bit careful there.
Yeah, it's interesting, too, to see some of the quote-unquote refinancings that have gone on that really weren't refinancings, but it saved a lot of companies.
Exactly.
I do have to ask you really quickly about the election cycle. You've been covering the financial markets and fixed income markets for a long time. For some reason, everyone's telling me that this election cycle is different. It will have a major impact on financial markets, primarily because of fiscal policies. And I want you to tell me whether I should be worried or whether some of these people who are raising these concerns are maybe just being a little bit too Pollyannish.
Yeah, we get this with every election cycle, and there's no doubt we have a fiscal policy challenge. We have a deficit that's rising. But markets, the bond market does not really care that much about this. And I think we'll probably find that out. Historically, it hasn't made that much difference. And not only that, we have to get past the presidential election, find out composition of Congress, and then find out what they decide to do. There's a lot of steps between here and there, and there's a lot of ways it could go. So I'm not really factoring it in as a big thing to worry about.
You sound pretty calm about everything. I'm wondering what you're worried about as we head into the election and into the year end.
Oh, well, there's plenty to worry about, but I tend to be calm anyway. But the thing that bothers me is we have so many conflicts around the world. You wake up every day and you don't know what market has been hit, whether it's a conflict in the Middle East, a conflict in Ukraine, and or global, climate change crises. You just don't know where it's going to come from, and it seems like it's always coming from somewhere. Mm-hmm. The other thing that concerns me from a political point of view is this trend we're seeing towards trying to influence the central banks. So from politicians, central bank independence to a great degree is really important to the integrity of the market. And if the market loses confidence in that, that would be a game changer.
Absolutely. Got to leave it there. Kathy, always a great conversation. Kathy Jones, Chief Fixed Income Strategist with Schwab Center for Financial Research, kicking us off to the close here on this Monday afternoon where we head down south and keep an eye on another major hurricane. It's been at least a decade since we've seen a hurricane intensify as fast as Milton has. We're going to discuss the potential impact in that state and the impact on insurance companies.
Plus, Goldman Sachs seeing a high bar for IPOs easing, how the market rally could make room for more initial public offerings.
And I'm told, Scarlett, that you like Crocs on your feet, but do you like to carry Crocs on your arm? We're going to talk about the hottest new bag out there. Some are calling it the Crocs of totes that is apparently winning over moms across America.
Moms, nurses, teachers, all of them.
All that and more coming up in a bit. This is The Close on Bloomberg.
U.S. IPOs are still lagging behind pre-pandemic averages, but Goldman Sachs sees things picking up as the current equities rally broadens out from a select few stocks. Bloomberg's Bailey Lipschultz sat down with David Ludwig. He is global head of equity capital markets at Goldman Sachs to discuss what current market moves signals for the IPO pipeline. Bailey joins us now. So, Bailey, what was the overall tone of what he was telling you?
I think, like most bankers, cautiously optimistic. I feel like we've been 3 months away from an IPO boom for the last year and a half. But the real kind of point that he made that really stuck with me was what he called a unique market, pointing out that if you buy the Mag 7 names, you're doing quite well. And if you're simply parking money in cash for the last 2 years, getting 4.5% plus on your money risk-free, there was no real reason to step out on the risk spectrum, buy new companies, maybe that PE wants to offload at a valuation you don't necessarily love, or even buy, a VC company that raised cash back in 2020 or 2021 at a higher multiple. So it does seem like we're getting back towards normal, but we've been talking about an IPO boom for, again, about 18 months at this point.
Did he talk about some of the valuations of private companies? Because we hear a lot about one of the reasons why we have this sort of logjam in new IPOs is the valuation of some of these private companies are still relatively high, at least relative to the correction that we saw maybe in public markets.
Yeah, I think that's a big point and has been a sticking point. He did talk about the IPO discount, so that's relative to publicly traded peers, was about 25%, he said, coming into the year, now closer to 15%. So you're still taking a bit of a haircut if you're a VC or a PE firm pushing a company public. But the general thought is, over time, as long as the company executes, you'll eventually be able to sell down stock in 6 months and through the next few years. But that still does seem like the big sticking point and something that some of these companies are going to have to either cave a little bit or do something to entice more buyers. Yeah,
to your point, about $35.5 billion has been raised through initial share sales on U.S. exchanges this year. That's up 61% from the stretch seen in 2023 through October 6th, but still well below the average in the decade before the pandemic. How much is the election a sticking point here? Because I feel like everyone's saying, once we get past the election, then things will return to normal.
Well, that's been the idea, is once we get rate cuts, we'll be fine. Well, we got a 50 basis point rate cut. Now it's okay. Once we get past the election, we'll have more clarity going forward, and if we can avoid a recession. So I think the thing that analysts, investors, and bankers are kind of leaning into is, in at least my view and my understanding from reporting this out, 25, there will no longer be kind of any excuses to not go public. If you're a private equity firm, you're going to have to take a haircut on that valuation. If you're a venture capital firm, unless you're well funded, you're one of the, call it, top 50 companies that realistically could stay private as long as they wanted to, you're going to have to at least meet investors halfway. And that's really been the big thing, though. One banker I talked to a few weeks ago made the joke, we'll revisit around MLK holiday and we'll see what the new excuses are.
Good luck with that. I just real quickly, though, I am curious about whether there is this idea that the companies that could come public, are they going to be the higher quality names, or are we just going to get kind of a lot of garbage coming through the pipeline that all these private companies have been looking to unload, investors?
I think you'll get a bit of both. So you'll get companies like Klarna. They've talked about wanting to go public. That realistically is a terrific company. There are companies like Canva, Service Titan, UKG. Those are some of the bigger names, more high-profile names that when I talk to people on the buy side as well as bankers, that they're circling. But to an extent, the worst place.
UKG? I know
they're in like the tech space.
Oh, I thought that was like a rap group.
No, it is. You know.
Okay.
I mean,
all right. Did you get new glasses? By
I did get new glasses.
Okay, this has been distracting me the whole time. I'm like, something's different about Bailey, but they look good on you.
Oh, thanks.
Yeah.
So wait, you mentioned Klarna, which
Back to the real questions.
I'm also dazzled by your glasses. Back to Klarna for a moment, because I feel like we've been talking about going public for a long time. Obviously, it doesn't have to, so it hasn't yet. But are there companies that really have no choice but to go public in 2025?
Well, that's what I was going to say. I spoke to a couple venture capitalists, and they said that's the worst place to be. If you can't get money at a good valuation that you like in the private markets, and you're going to be forced to go public, you're going to take even more of a haircut on that valuation or what you think you're worth or want to be worth. Again, maybe that 15% discount gets closer to 30, which is something we saw within the last few years. But certainly we're seeing companies, at least board members, early investors, getting to a point where unless they can exit privately, you're going to have to do something, because these companies and these firms need to return cash to their investors in order to go out and raise another fund.
All right, Bailey, great stuff. Bailey Lipschultz, who covers this for us here at Bloomberg. A closer look at the potential here for new IPOs coming down the pipeline in 2025. When we come back after the break, we're going to take a closer look at shares of Amazon on the back foot all day long after Wells Fargo snatched its buy equivalent recommendation. That's coming up next in our top calls right here on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Coty, the beauty company, getting a bump up to buy from hold over at Jefferies, with the analysts calling the beauty product makers lineup a prestige portfolio that can expand further to drive growth. She also notes how important it is that Coty is less exposed to China and travel retail compared to its peers. Coty shares having a pretty good day, up about 4%, second straight day of gains. Next up, we're keeping an eye on Netflix. Some conflicting opinions out there on the streaming giant, with Piper Sandler upgrading the stock to overweight, but Barclays cutting to underweight. Simply put, Barclays says revenue growth isn't where it should be to justify current valuation. And while initiatives like paid sharing have pulled forward some subscriber growth, Netflix's valuation prices in more than double its current subscriber base. We should point out Barclays is just one of 3 sell equivalent ratings among the 60 plus analysts covering this stock. Netflix shares down 3% on the day. Let's take a closer look at Amazon. Those shares also down about 3%. This after Wells Fargo became the second bank to downgrade the stock in less than a month. A cut today to equal weight and a price target slash to almost a near street low 183 from 225. The analysts saying the strength of Amazon Web Services won't be enough to overcome headwinds in the company's other businesses. That includes some concerns here about moderation in advertising profits. You see the shares there down about 3%, down around 180 and change. Those are some of our top calls as we continue on that last one. And pleased to say that the analyst behind it joins us right now. Ken Gawrelski is an internet analyst over at Wells Fargo. A recent downgrade here on Amazon. And Ken, I look at this stock and I think about the contribution that this company has gotten from Amazon Web Services. Is your thesis here that the other parts of the business will be too weak for that to matter as much as it has in the past?
Yeah, it's a great question. This has really been a stock that has had 2 really strong drivers, right? They've been firing on both cylinders. You have AWS on the one hand that has accelerated from the low teens to now 19% in the last quarter, and we expect to 21% in the third quarter. So really strong acceleration, really doing great on the AWS in the cloud business. And then you have the retail side, and the retail has really been a margin story, right? That's been a margin expansion story in the North America retail side. And so what we see here is that this margin story is taking a bit of a pause, right? And really, the North America margins underperformed in the first half of this year, and we expect them to underperform through the first half of next year. So we're taking a bit of a pause. The longer-term North America margins should still continue to be healthy.
Yeah.
But in the near term, we see a pause here.
I am curious. One interesting thing in your note, and this is on the e-commerce side of it, with regards to the competition that Amazon has as one of those sort of scaled-up marketplaces. You specifically mentioned Walmart and some of the inroads that they made, but you're saying that the market share that they might be taking isn't necessarily coming from me, meaning the end consumer. It's more on the merchant side. Explain that.
Yeah, that's right. So on the core consumer side, we are not factoring in any significant share gain from Walmart as a marketplace. Walmart marketplace is, let's call it 10% the size of the Amazon marketplace. However, there's another part of this business to think about, which is the merchants. Right, the merchants on the Amazon marketplace really have had very few alternatives, very few scaled alternatives in the logistics and fulfillment side. And the difference here now is that we believe the competitive marketplace now includes Walmart as a provider of third-party fulfillment and logistics services. And what we see is there will be more pressure on these fulfillment by Amazon fees, and it just means that they will grow less rapidly than they have in the past.
Okay, less fast and less rapidly. Going back to retail and the margin story overall, Amazon's going to launch Prime Day tomorrow. It's October Prime Days versus its July Prime Days. Are Prime Days bad for its margins?
Well, I don't know about. Look, these are big promotion events, and a lot of that is merchant funded, right? So, as to whether they're bad or good for margins in themselves, they're an important part of the business, and there are also many competitors that have launched similar promotional events around. But what we learned, what I think is interesting, is in the July Prime event, what we saw there was average selling price come down for the goods sold. That was actually a really interesting indicator for the consumer and for Amazon's business overall, which saw average prices come down. We'll be looking for the next couple of days. It's really less about the overall sales, and it's more so about the dynamics and that average selling price. We're going to be looking to see the health of the consumer in that average selling price number. And
very quickly, is the advertising business a net positive or net negative here?
Oh, definitely net positive. I just think it is less positive. It will grow. It won't grow as quickly as it has over the last several years. And what we're really talking about is that core merchant advertising, which has been a great driver over the last 3 to 4 years. We just think that growth moderates.
Got it. Ken, really appreciate your joining us. Ken Gawrelski over at Wells Fargo.
Thanks
downgrading Amazon to equal weight, and it's one of the very few equal weights remains. 74 buys, 5 holds, and 0 sells on Amazon.
Yeah, and it's kind of interesting. So when you start to go against the grain here, it'll be interesting to see how that plays out when we get to earnings.
All right. Coming up, oil rising to $80 a barrel for the first time since August. Insight on global oil from Paul Sankey of Sankey Research. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And it feels like all weekend long we've been waiting for some kind of headline out of the Middle East, and we still haven't gotten it yet.
Yeah, we haven't gotten it. I mean, you're talking about it as a resolution to what's going on over
even
there.
Just the next move, right?
Yeah, absolutely. And it feels like it's, at least in the minds of a lot of traders, it might be getting worse, or at least a little bit more disruptive for those folks who are trying to sort of game out the system.
Absolutely.
Yeah.
So if you look at the oil market, you look at Brent crude, it is soaring today above $80 a barrel. It is the highest price since August as tensions in the Middle East stoke anxiety among traders. So we want to bring in now, with more on his outlook on oil, Paul Sankey. He is lead analyst of Sankey Research. Paul, how much of the $10 move over the past week is tied to fears over Israel attacking Iran's oil infrastructure if it moves in that direction versus, say, expectations of fewer Fed rate cuts?
Well, I think the other thing that you would throw in was obviously the China stimulus, which is really two major news events that combined with a massive short position. The first time that we've seen oil speculators overall net short oil came right before all of this upside news flow. And so what we're seeing here is an epic short squeeze. And as you say, everybody is now just waiting for what the actual catalyst news is going to be. It's interesting that now oil volatility is considerably more expensive to the upside than the downside. And history says that the next move is likely to the downside, just in the same way that we just saw a big upside move because everyone was short. The risk is now, in our view, very much to the downside. But then again, we were bearish, $10 or $15 lower than here and getting chopped up. So.
Like so many others. You call this an epic short squeeze. How far along are we in squeezing out all those shorts? Are we like 2/3 of the way through, 3/4 of the way through? Are we done with it?
Well, certainly we've gone net long, yes. So that the absolute net short has rapidly been unwound literally over the past 3 or 4 days. And so, we're getting there in terms of the unwind. But of course, there's another thing. There's a couple of things I think that are worrying people. One is that when the oil price starts going up, everyone starts worrying that somebody else knows something that we don't. So there's definitely a lot of fear in this move as well. But ultimately, I think we've also had a couple of major Israeli events. The Rosh Hashanah may have delayed things, and then of course today is the terrible anniversary, October the 7th. So it's not, I think there's also a wondering as to whether or not we will still get some sort of major action, but we just had to wait sort of thing. And that's keeping us all absolutely on tenterhooks.
I am curious in terms of some of the positioning that we're seeing, or maybe the unwinding of those positions, Paul. I feel like we were here before back in April, maybe again sometime in the summer, where we saw prices spike. A lot of shorts got squeezed out, but as soon as the coast was clear, it seemed like everyone piled back into those short breadths. Do you think we're going to see that again this time if we do get some semblance of a resolution as to what's going on in Israel and the Middle East?
We really do. I mean, obviously, you'd have to temper that with whatever actually happens. So, I mean, we don't know how bad it would be, but we just don't think that Israel wants to upset the world, and obviously, if there was to be some drama around oil and oil interruption, you've also got to think about all the LNG going to Northeast Asia from the Gulf. I just think that there's too much collateral damage here, literally, in terms of what could happen if Israel does go after the oil infrastructure. Obviously, you're 30 days-ish, even less now, before the U.S. election. And, I'm sure the Democrats are going to be asking them to temper anything that they're going to do. Would they attack the nuclear? I mean, that's the alternate theory, Iranian nuclear. Again, that would be a major escalation that could terrify people. So we just have to, at this stage, we just have to wait and watch. But there's been some bearish news fundamentally, even today, with Libya back at 1 million barrels a day. So the underlying market is actually only deteriorating around us. And so I agree with your precedent that we'll probably sell off pretty hard once we get this news.
Because that's what I'm curious about, too. And maybe you could just kind of put this into context. And forgive my ignorance, but when we talk about Iranian supplies being significantly disrupted to the point, is what they're putting onto the market right now, at least what we know that they're putting on the market right now, is it that large that would have global reverberations, or would it primarily just affect those folks that are still trading with Iran?
It would primarily, obviously, affect Iranian trade. I think the question is, if you get into attacking tanker export ports in the Gulf, do you get a situation in the Straits of Hormuz? There's a number of. It's an area that makes people very nervous, obviously, and the historical precedent is that anything bad happening down there is bad for oil. We highlight as well that it's a very different world today in oil than it was in previous Middle Eastern crises, because the U.S. is now a net exporter of oil. So the risk for the U.S. is massively mitigated against previous situations, even you could argue as recently as the Abqaiq attack in 2019. The U.S. has only continued to grow since then, and our exports have only grown too. But generally speaking, Abqaiq has been one of our precedents where you saw, a significant attack that didn't have a very sustained impact at all. In fact, within 6 months of Abqaiq, the major attack that saw 7 million barrels a day taken out in Saudi Arabia, oil prices were negative within 6 months.
So if Israel does attack Iran's oil-producing facilities and Iranian oil exports would be disrupted, we expect China, which of course buys a lot of Iranian crude, to be affected. But what do we think in terms of what other countries? I think we lost Paul Sankey there. Unfortunately, I was going to ask about what other countries might try to make up for that lost Iranian crude and rebuild that supply?
Yeah, we've posed that question to other guests, and I think the general consensus is that everybody is either at or near capacity right now. So I'm not sure how much wiggle room is at. I mean, that's just my layman's perspective from some of the folks we interviewed. But it gets to the other point, too, here. Like, we're not just talking about oil supply. And he brings up a good point. We're talking about infrastructure. So we're also talking about if there's a disruption to that infrastructure, meaning it's bombed or something else, you're not getting that back online.
Yeah,
quickly,
that's true.
Right?
Yes.
A hurricane comes through, you're going to be back online in a week after the storm has passed. If something like these worst case scenarios that people seem to be bandying about comes out, we could be talking about months, if not years, of disrupted supply.
That's a good point. Although Eurasia has put out a note saying that Iran seems to be preparing for an attack on its crude export facilities. It has satellite images. It's been looking at that, and it's indicating that it's pulled most of its tankers away from one of the areas where most of the oil exports originate. So we're not sure behind the scenes what's going on, but it's an important point where once you attack infrastructure, that could be months, if not years in the making in terms of trying to get that back online. Yeah, absolutely here. And it's going to be something, of course, that is going to become an issue in the presidential election and maybe even beyond that. Of course, we should also point out that we have to talk about the disruptions from Hurricane Milton on the oil sector. And when we come back, we're going to talk about the impact on insurance companies as well. Insurance companies are really bracing for that impact as millions now in Florida are being told to evacuate a Category 5 storm right now in the Gulf of Mexico, though not expected to hit landfall until at least late Wednesday. It'll be interesting to see how things react and how investors respond. That conversation coming up after the break. This is Bloomberg. All right, time now for our stock of the hour. A closer look at insurance stocks, which are taking a hit today as Hurricane Milton strengthens to become a Category 5 storm in the Gulf of Mexico as it approaches Florida. This happening just about a week and a half after Hurricane Helene slammed the state. Abigail Doolittle joining us right now to talk a little bit more here about how some of these stocks are performing. We should just point out the White House out with an official statement on preparations here for the landfall, which is expected on Wednesday night from Milton. And we mentioned Helene, which of course hit in the Big Bend region a little bit further north just about a week and a half ago here. This is two massive storms, Category 4 and now a Category 5 out in the ocean that could potentially make landfall somewhere at that same intensity.
It is, and experts are comparing it to Ian relative to the insurance losses. In terms of right now, it's a Category 5, as you mentioned. It is expected, though, to hit some other weather systems out on the sea, so that by the time that it hits the Tampa Bay area, it's more likely to be Category 3. However, the Category 3, the Tampa Bay area, the property values are higher. So even though it may be less than Ian, which was a 3 to 4, it's hitting these more valuable homes. So in terms of the insurers, this is going to be a really big hit for them. Allstate and Progressive down sharply, but we should really make a distinction. So relative to Florida, Allstate and Progressive, they do have exposure. The biggest insurer for Florida is the state fund called Citizens. That's basically the insurer of the last resort if you can't get insurance from somewhere else. So that's the biggest one. That's not a public company that we can take a look at. But two other public companies that are smaller but have a ton of Florida exposure, Heritage and Universal, those stocks really plunging, down more than 20 and 10% respectively. So for Allstate and Progressive, it's likely to be an earnings event, not a capital event. One of my sources did tell me, though, for Heritage and Universal, this could actually wipe out these companies, mainly because the losses will be greater than equity shareholder value. Yeah, I'm also looking at HCI Group, which is down about 17%. So I think it's got more of that regional exposure. It's based in Tampa, in fact. So when it comes to these insurance companies, obviously they also get insurance for themselves too, reinsurance. What do we know about how the reinsurers are trading today? So the reinsurers are also down. And a couple examples: Arch, Everest Group, Renaissance. Renaissance is the one that has the most exposure to Florida. So they are down on the possibility that there is going to be a move lower here. You know, something that's interesting, you were talking about Helene, Romaine, and there's varying reports about what the response was to that disaster. And in terms of the insurance company, I think that one reason that there may be, I've seen a lot of videos that are just really stunning, but it's not being considered this big hurricane from a loss. From an economic loss standpoint, our Bloomberg Intelligence analyst told me it will be $200 billion. But for insurers, it's closer to $10 billion, whereas this hurricane, Milton, is more likely to be significantly more than that. Ian, for a point of perspective, the one that we're comparing Milton to, is $65 billion. So it's just really interesting, the loss that insurers take versus the economic loss, the human loss. It's really a tough situation.
Gotcha.
All right, Abigail, thank you so much with our stock of the hour, stocks of the hour. And by the way, you can track the path of Hurricane Milton by typing in MAPS or HURR-GO in your Bloomberg terminal. All
right, we see those those insurance stocks, I should say, moving lower on the day. So too is Alphabet. The shares hitting fresh session lows. This after a judge issued an injunction in that epic antitrust fight. We're now learning just a few minutes ago that Google does plan to appeal that verdict. But remember, this has been a long-running dispute between Google, the search engine, and its Play Store, and the way that it allowed third parties to monetize in that store. Epic Games, of course, sued. They have now won an injunction that takes effect on November 1st. That's assuming that there isn't a stay of that injunction pending the appeal by Alphabet. Google saying that it plans to appeal that immediately.
And Epic Games, of course, the company behind Fortnite, which everyone's teenagers seems to be playing. I don't know if they still do, but they were several years ago. Coming up, we take you to the bells with Amanda Agati, Chief Investment Officer at PNC Asset Management Group. This is The Close on Bloomberg.
But the underlying trend is a pretty healthy economy defying gravity, despite all the constraints that have been thrown at it with tight monetary policy, weak global growth, wars and conflicts around the globe. And consumer sentiment being really poor, and yet consumers spend money because they have jobs.
Kathy Jones over at Schwab kicking us off to the close just about 10 minutes ago. And while sentiment overall in aggregate might be good, at least for today, looking a little bit bad, stocks still around the lows of the day on a day here where we're seeing a massive move higher in Treasury yields.
Yeah, and it was really the jobs report that changed the tone for the bond market. Everyone's repricing what the Fed will do next. Yields up across the curve, especially at the short end. That is weighing on equities today. There's no economic data. And we have declines of about 0.9% for the S&P and the Dow, and for the NASDAQ, greater than 1%. But really, the losses have deepened in the insurance sector, where we are awaiting Hurricane Milton. It is now officially a hurricane. And I wanted to point out a couple of gainers here, and that would be the XLE, the ETF that tracks energy stocks, marginally higher as oil prices continue to move north. And also pointing out that FXI, the ETF that tracks Chinese shares, also higher before Chinese markets reopen tomorrow.
Yeah, it'll be interesting to see exactly what happens when all of those folks come back to the market in China, given the relentless rally that we saw over there. Meanwhile, the rally in the U.S. on pause with more than 400 S&P stocks moving lower here, as there is a big rethink going on right now about just how many rate cuts we're going to get this year and next. Amanda Agati joining us right now, Chief Investment Officer at PNC Asset Management Group, with just about 8 minutes until these closing bells. And Amanda, I do want to start off with rate expectations, because there really was kind of this playbook that had been written, I think, over the last few months. This idea that we were going to get 75, 100 basis points of cuts this year, maybe an additional 75, 100 next year. And thus, it was off to the races. And now with the strong jobs report, along with some other relatively encouraging macroeconomic data, do you completely need to rip up that playbook, or maybe just whittle away at it around the edges?
Well, it's always nice to be with you both. So thanks so much for having me. I'm sort of ripping up the playbook and throwing it in the trash as it relates to Fed policy from here. But I'll just say that we were definitely in the camp that, they did not need to move really that aggressively out of the gate, given the still strong underlying data that we've been seeing so far. Of course, they're recalibrating policy. We understand some of the key reasons for that recalibration, but The market always wants what it may not actually believe is good for it. It wants the sugar high from more policy accommodation. So the market's sort of throwing a little bit of a tantrum as it relates to how many rate cuts. But I think given how strong the data is coming in, we need a little bit of a sanity check here. And so it is still right to recalibrate policy, but I think the next move is no more than 25 basis points for sure.
And I'm curious, I like the fact that you use the word sanity check, because we're still talking about yields right now, at least Fed funds, we're right around 5%. They've made it clear that it's probably going to come down a little bit more than that. So we're basically talking about, even in the worst case scenario, a Fed funds rates in the 4 somewhere. Economy, at least based on the data that's holding up, I would think that would be enough for folks to maybe find some opportunities in this equity market beyond just the Mag 7 and the big cap tech stocks.
Oh, absolutely. I mean, we think there's a lot of opportunities, particularly in the quality part of the market, which hasn't really participated to the same degree that the Mag 7 rally has over the course of this year. And so valuations in many of these quality-oriented exposures aren't anywhere near price to perfection, despite the strength of their underlying fundamentals. So we do see pockets of opportunity for sure, but I think this recalibration still needs to happen a little bit in terms of expectations. I think if you look out about 12 months from where we are today, we're still looking at about 200 basis points of decline in rates from here. That is really strong in terms of an underlying sort of fundamental tailwind for the parts of the market that need it the most. So small and mid cap equities will feel the biggest benefits. The lower end consumer should feel the biggest benefits. So there's good things happening out here. You just have to look beyond the top 5 or 7 names.
Sure.
For sure.
You mentioned opportunities. How much of an opportunity are energy stocks? Do they qualify as quality, or is it just kind of a knee-jerk reaction to the moving price of crude?
It's a knee-jerk reaction. I think it's certainly a reflection of the geopolitical conflict and the tension that continues to rise, certainly here. And then, of course, with what's happening with the hurricane in the Gulf, that stands to potentially impact supply to some degree. So I think it's much more about headline risk rather than a fundamental reacceleration there.
How are you thinking about financials as we await earnings from the biggest banks, including JP Morgan and Wells Fargo on Friday?
Well, financials have been in a tough spot here for a decent period of time as it relates to the shape of the yield curve and how business models tend to be leveraged to it. And so we've started to see a little bit of steepening in the yield curve, which should be good for net interest margins longer term, but it literally just happened. And so I think the challenge in this environment is everybody thinks first Fed rate cut, shot in the arm, boom, we're off to the races. It takes some time for that to flow through. So I'm not convinced that this earnings season is going to be a particular tailwind or home run necessarily for the sector, but I do think that the tailwinds are going to start building. So over the next couple of quarters, we should see some really strong momentum out of financials.
So are you relatively, and I'm talking more earnings overall, not just financials, Amanda, are you relatively comfortable with valuations based on your expectations for this earnings season?
Not at all. Not at all. We continue to believe that the S&P 500 is priced to perfection here. I think that is a key governor in terms of how far this market rally can continue. We've had some pretty significant negative revisions over the course of Q3 coming into earnings season. And so it's not looking particularly great in terms of a catalyst for Q3 earnings season. I think it's going to be really important to see how this earnings season plays out, because it will translate into how this year finishes out and whether 2025 earnings growth expectations are too high or not. I think there's room for them to come down a little bit from here. I'm not looking for the bottom to drop out, but I do think we need a little bit of a reset in terms of expectations.
All right, Amanda, great stuff. Going to leave it there, and we'll talk to you during the earnings season, I'm sure. And Amanda Agati, Chief Investment Officer over at PNC Asset Management, helping us count down to the close with just about 3 minutes to go. And I thought it was interesting. There was a great note out by the strategist over at Bank of America that said this earnings season is going to be a stock picker season, given all of the implied moves out there and the idea that this is going to be a much more idiosyncratic type of earnings season rather than a rising tide lifts all boats.
Yeah, the easy money has been made in many ways. We talk every day about Fed speakers that are coming out. Neil Kashkari said something, and he was fairly bullish, I should say dovish, excuse me. A lot of confidence that inflation may come back to its 2% goal. It did nothing for the market.
Yeah. Well, maybe we just have to wait till he speaks again, because I'm told these people speak quite a bit. And we talk about Fed pricing here, and of course the big moves that we're seeing in the options and swaps market today, repricing out some of those rate cut bets, a yield curve that at one point on the day actually re-inverted. A full breakdown coming up right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you to the Closing Bell, a global simulcast. It starts right now. We're joined by Carol Massar and Tim Stenovic in the radio booth. Alex Steele on assignment today as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube on a day, Carol Massar, where we're only seeing about 100 stocks in the S&P 500 in the green.
Right.
Which ones are your favorites?
Yeah. Well, you're going to find out in just a moment.
She doesn't play favorites.
Among stocks. I just think what's fascinating is to see, 4% again on that 10-year. We were talking to Michael McKenzie, who follows the rates markets here at Bloomberg last week. And I said to him, could we get to 4% again? He's like, yep, we could. And here we are. So it's just a new narrative. And I guess I just wonder, Tim, at this point, how long it lasts.
The first thing I did today, I actually called up my high yield savings account, which just cut my rate about a week and a half ago.
Really?
And I said, are you going to raise it back now?
And
I think I was just talking to like an AI bot.
I got two.
So it was kind of a pointless conversation.
I got two emails in the last week.
What a good story.
Two emails in the last week about them cutting those high yield savings account rates.
Yeah, it's not high yield anymore.
Yeah.
No.
Still high-ish yield, right?
Well, maybe that'll show up in bank earnings, if not in Romaine's bank account, right?
Nice segue. Net interest income comment coming in.
Oh,
yeah. Well,
we like to talk about those net interest income. Oh, that's right. It's bank season. That's coming up this week, right?
Yeah, exactly.
Friday.
Have you prepared? No, of course not. I cut you off guard. Maybe Tim will wear a tie on that day. It'll be the first time in history. Carol Massar, I don't know if she's working a full week or not, but if she is here, she'll be there to help cover it as well. We get the closing bells here in New York on this Monday afternoon. Not the best Monday afternoon, not necessarily the way people thought it would look, but nevertheless, they're required to clap as usual. Take a look at that. Microsoft actually ringing the bell over there, where the Dow Jones Industrial Average down about 400 points or 0.9%. A similar percentage drop on the S&P 500 as it closes back below 5,700. A NASDAQ Composite down about 1.2% here, and your Russell 2000 also moving lower, decline of about 20 points or 0.9%.
Yeah, it wasn't just the Joker that had a bad weekend. Anybody who was trying to be... Ouch. I know. It's like...
Did you watch that thing?
No, I did not. Okay. But so, a lot of people didn't go, or they walked out. We'll get to that later. Hey, the S&P 500, as you mentioned earlier, Romaine, most names in the index lower today, 396 to the downside here as we settle in, 107, Scarlett, to the upside.
All right, taking a look at the sector performances, there's a lot of red on that screen. In fact, the only slice of green there is energy stocks, and even that group is barely higher, up by 1/3%. The worst performers here, utilities losing 2.3% on the day, communication services and consumer discretionary each down about 1.9%.
All right, guys, let's get to some of the individual gainers. I'm hoping they held. Otherwise, they're going to make fun of me. Pfizer, off its highs of the day, it was up about 4.5% at its highs, still finishing with a 2% gain. And, of course, we know, according to a person familiar, activist investor Starboard Value has taken a stake of about $1 billion in Pfizer, specifically said to be looking for a turnaround. I mean, what is Pfizer going forward in terms of a post-COVID world, right? It was banking on those COVID vaccines to really keep kind of the momentum going. But this is pharmaceuticals. They're always looking for their next big thing. So we'll see what happens and whether or not some changes happen at Pfizer specifically. Supermicro having a very bullish day. This one finishing just off its highs. One of the top gainers we saw in the S&P 500 and the NASDAQ 100, about a 16% gain in today's session. The company did disclose shipment data. Bloomberg Intelligence out saying the data suggests customer demand is robust, hasn't been dented by the company's internal stumbles, such as a 10K filing delay in reported U.S. probe. They also went on to say that SMCI's figures represent a good foundation for reaching its first quarter sales guidance midpoint of $6.5 billion. So some upbeat comments by our BI team. I do want to point out Duckhorn Portfolio. This was a name courtesy of Tim. Thank you very much,
That's
Tim.
Me.
Finishing up 102% in today's session. It's about a $1.6 billion wine company soaring. It was taken private by Butterfly Equity in an all-cash deal that values it at about $1.95 billion. And just because it is election season, I did want to take you to Donald Trump's media company. DJT is the ticker, Trump Media and Technology, finishing up about 11.5%. Not quite sure why. It's been on a rally the last 3 days. Elon certainly was at a rally over the weekend, but you also have to keep in mind the stock's been under pressure after the lifting of restrictions for insiders. So maybe, I don't know, it's kind of bouncing back from some of that.
Taking a look at the stocks that were lower today, mega cap tech really dragging down the major indices here. You got Apple down by more than 2.2% today. This after an analyst over at Jefferies said investors have an overly optimistic expectation for the company's latest iPhones. Romaine, how is the new iPhone?
I have to ask my son. I mean, he loves it. I mean, it's the greatest thing since sliced bread, according to him. So,
okay.
I don't know. I mean, I don't know.
Wait, is it
Tim.
your phone or his phone?
I use like 2 apps. So, I'm like the worst person for all this Apple stuff anyway.
All you need is the Bloomberg app. It's the only one you need.
Oh, we have an app?
Yeah, we have a great app.
Okay.
Edison Lee over at Jefferies, he wrote that, quote, the high expectations for the iPhone 16 and 17 are premature because there's a lack of material new features and limited AI coverage. So there are high market expectations and they're unlikely to be met. I do want to talk about what happened with shares of Alphabet falling 2.4%. They fell after a judge ruled that the company must lift restrictions that prevent developers from setting up rival marketplaces that compete with its Google Play Store. It threatens Alphabet's dominance in the Android app market. Alphabet did come out and say just in the last hour that they will appeal the Epic Games verdict. A big victory, though, to Epic Games in its long-running antitrust challenge to Alphabet's App Store, which brought in more than $14.6 billion in sales back in 2020. Also, Amazon shares falling today. I think I looked up on the screen and saw Ken Gawrelski on your air. He's the Wells Fargo securities analyst who cut the stock to equal weight from overweight. One of the few analysts who's tracked by Bloomberg who doesn't have a buy recommendation on the stock. The downgrade cited concerns over margin trends into next year. Growth in the cloud computing business is unlikely to compensate for, according to this analyst, shares falling by 3%.
All right, let's take a quick look at yields because we did see a meaningful move higher for a fourth straight day here. And just think about where we were on a 2-year yield just less than 2 weeks ago. We were down around 3.5%. At one point today, we did trade above 4% on the 2-year yield, though it looks like we settled just below that. Still higher by 6 basis points on the 2-year. Similar moves on the 10 and the 20-year. Your 30-year yield now at 4.3.
Kind of remarkable. Also remarkable is what's going on with gold. As it continues to we see some records taken out. We see over at Costco that gold bullion is apparently, Tim, right, flying off the shelves.
Yeah, it's bringing gold buying to the masses. They offer prices that actually undercut traditional precious metals dealer, extra rewards for most loyal customers. Now there's the appeal also as a safe haven and a hedge against inflation. So kind of easy to see why gold is flying off the shelves. Do you have to buy a 6-pack of it, though?
I don't know. Probably. You probably have to buy like a 20-pack.
Yeah.
I just want to say I actually averted a Costco run this weekend.
How?
I went to go visit my mother, and she wanted us to take her to Costco.
You can't break that streak, right? You have to continue to not go to Costco.
I told her that absolutely not.
Meaning like
Sorry,
you've never
Mom.
been to Costco and they're trying to never go?
My love is unconditional.
He just refuses to go to Costco. He's fundamentally against it. You know, the thing with these little gold bullion bars is that if you buy more than one, as several people in this story have apparently, then you got to buy a safe because where are you going to put all this gold, right? You got to sign up for safety deposit boxes, or you get a safe, which is also available at Costco. So it just kind of, it's a virtuous cycle
just
here.
melt it down, put it all around your neck, and just walk around like Mr. T.
I'm there.
And you OG.
Yeah.
Over gold. Hey, did you guys see Joker 2?
I don't think anyone
Part
did.
Due,
I think
or
that was
whatever
the
it's called?
problem.
Yeah, well, actually about $40 million worth of people went to see it. Kind of interesting, too, because this was well below what analysts had thought that this would take in at the box office. And more importantly, it appears that the people who did spend $40 million to go see this absolutely hated it. And I don't know exactly what's going on here. Yeah, that looks really good there. I mean, I normally like this guy, and I don't know, Lady Gaga, eventually she'll learn how to act.
Well,
but what is going on with...
Is it a musical? Is there singing or something that goes on in it?
Lady Gaga's in it, so there's got to be singing. But
Yeah,
I mean, isn't this
musical.
the wrong demographic?
No.
Like, it's not a superhero movie, but like comic book movie tied in with a musical.
Our review
Lady
on the
Gaga?
Bloomberg
I mean,
by
it's like
our
pop
reporter says the movie is a punishingly dull affair. It's a pointless sequel with very little plot. It wastes the talent on screen.
Is that bad?
Yeah, that's not great.
Okay.
It's got French in the title too. Joker folie à deux, so that makes it hard to get on board too.
Isn't it the Post that had a story that people were just walking out of the theater?
Yeah, there was a lot. Well, I mean, the thing is, too, I mean, it kind of gets to this idea of expectations. Anytime you have these sequels, particularly with these kind of superhero type movies, expectations usually are so high. And so it's almost, and then you have a new director coming in who's always going to put his or her spin on it. And I guess people didn't like it. But you know what?
I don't know. The Marvel guys seem to do okay for the most part.
Aren't we tired of all these franchise movies? Wasn't that the takeaway from, for Disney?
I think so.
Warner Brothers Discovery needs to get the memo on that.
This is DC Comics. It's even worse.
Let's all go to Costco and buy some gold.
Scarlett, not the same thing.
Let's get Romaine to Costco and let's just go.
No.
Yeah,
it was a close call. I mean, I really thought I was going to have to go.
What would you have gotten if you went to Costco? Because you would have had to get
I
something.
don't know. She just wanted to stock up on stuff. I was like, that doesn't sound like something I want to do.
Lisa Mateo says there's great hot dogs.
So, I don't know.
It's like $1 something or something.
And the raspberry slushies, too. The berry slushies. Okay.
All right, we got to run. That's our Monday wrap, guys. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. We will see you again, same time, same place tomorrow.
And we continue our coverage right here on Bloomberg Television. A closer look at that massive rally that we've been seeing in Chinese markets, despite the fact the mainland markets have actually been closed for the last few days. But they're set to reopen, and a lot of people are expecting fireworks. That conversation coming up after the break. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Let's take a look at how Wall Street performed here on this Monday afternoon. It did not perform well. A bit of a rewind, if you will, coming off that big rally that we saw on Friday, a reassessment not only of the health of the economy, but more importantly, whether or not we're actually going to get those jumbo rate hikes that the market had priced in. An S&P 500 moving lower by about 1% on the day. Similar moves for the other major indices on a day where we saw a re-inversion of the 210s curve. We did settle right around 3, but at one point on the day, it did get back to that negative side here as we saw a lot of selling here that pushed yields higher, particularly on the shorter end of the curve. Keep an eye on gold. That was all over the place today, despite the fact that it did end in the red. And kind of interesting, too, we talk about the China trade. The MSCI Emerging Markets Index higher on the day. That's only because of China. You back out China stocks here, this would have actually been in the red, and that's going to be a huge setup heading into tomorrow when the mainland stocks open.
Absolutely, and we'll push ahead to that in just a moment, but I do want to take a look at some of the day's big movers here, and they include Pfizer, which closed off of its highs. At one point, it gained as much as 4.4%. Bloomberg has learned that activist investor Starboard Value has taken about a $1 billion stake in this drug maker that is in transition after the successes of its COVID vaccine. And insurers making up among the worst performers in the S&P and the Dow. Everest is a reinsurer. Travelers, of course, a property and casualty insurer. This is as Hurricane Milton intensified on its path to Florida, which, of course, that area is still just recovering from Hurricane Helene less than 2 weeks ago. But as Romaine mentioned, we want to go back to the story of the hour and of the day, which is the rally in Chinese stocks has more room to run when mainland markets reopen tomorrow after a week-long holiday. Now, over the past week, inflows into U.S.-listed China ETFs saw almost $5 billion. That is the most on record. Goldman Sachs says it sees gains of another 15 to 20% if Beijing delivers on its policy measures. And the reason, valuations are still cheap, earnings may improve, and global investors are extremely underweight on China. Romaine?
All right, well, let's go from China to Japan. The yen coming off of its worst week since 2009. That was on the back of that robust U.S. jobs report and dovish comments by Japan's new prime minister. Joining us now to discuss maybe where the next direction is Win Thin, global head of market strategy over at Brothers Harriman. We did see a bit of a rebound today in the yen, but not enough to recoup the losses from last week, Win. And I am curious as to exactly where investors actually think this thing is going to go.
Well, first of all, Romaine, Scarlett, thanks for having me. It's always a pleasure. If you really think back to the last couple of years, the strong yen call has been one of the biggest out there, and it's, for the most part, been the most wrong as well. Why is that? Well, it's always been predicated on a hawkish BOJ and a dovish Fed. Both sides of the dollar-yen coin were supposed to line up in favor of the yen, but we just simply haven't seen that. Yes, the Bank of Japan has hiked twice, a hawkish surprise in July. That sort of started this last leg of this rally. But since then, because of all the fallout in the Japanese markets and actually globally, as well as the Fed turning out to be much less dovish than markets expected, we're having trouble with that trade. I've always been skeptical of calls for dollar yen down going down to 125 and even below. I think we're stuck in this sort of 140, 150 range until the monetary policy stories become clearer. But if anything, I would say the risk is that we go above 150 rather than below 140.
I am curious that when we talk about the rate differential, because obviously that's a big driver of the moves that we've been seeing in the yen, even if you do believe that the Fed may either pause or at least not be as aggressive as what was previously priced in, I got the sense, and maybe I'm wrong here, that we were going to see maybe a little bit more movement on the Japanese side so that differential between the two would not be as wide.
Yeah, absolutely. Again, and that was the thesis that was sort of underpinning it, but we just simply have not seen that. Besides the market turmoil, we've seen the data out of Japan soften. We've got the incoming government that it's really quite nervous as reports that they're going to introduce some sort of economic package ahead of the October elections. So what we've seen is that the Bank of Japan has actually successfully pushed back against market expectations. If you look at your great MIPR page, which is sort of long-term interest rate expectations, the market is pricing in between 25 and 30 basis points of tightening over the next 12 months, which is really a drop in the bucket, right? And to me, that's not enough juice there to get us down to 125, 135, et cetera. I think the monetary policy and economic divergence stories continue to favor the dollar. So I remain skeptical of the strong yen trade.
So I've got to ask you about the politics of Japan, right? Because the new Prime Minister, Shigeru Ishiba, said Japan is not ready for further interest rate hikes. And of course, that was a huge surprise to everyone in the FX market. How much independence is there? How much independence can the BOJ exercise given the change in government?
Yeah, I know. That's always been sort of an age-old question. Governments have been known to lean on the Bank of Japan. I think my view is the Bank of Japan is much more independent than they were, say, 10, 20 years ago. But there's certainly, I think, a bit of a political element that they had to deal with. The jawboning has already began. They are being, I think the Bank of Japan is under great pressure to keep monetary policy loose. Again, the data are softening. If you're a politician, you want to go into an election with good confidence, people feeling good about the economy, et cetera. So that pressure will certainly be brought to bear even more. And again, I think that the data sort of support this. If you think about it, the Bank of Japan simply waited too long to start tightening policy, to tightening right into the softening patch. And look, hey, you can't blame them. The last two times they've hiked rates, they've fallen back in recession. So one cannot blame them for being sort of gun shy about hiking. But here we are.
Yeah. Who would you watch for in terms of really being able to drive the movement of the yen? I mean, once upon a time, it was Mr. Yen. Is there a new Mr. Yen in 2024, Win?
That's a good question. I do think Mr. Ueda, the governor of Bank of Japan, is in the driver's seat in terms of the Japan side. And obviously, Mr. Powell is in charge of things on the U.S. side. So those two gentlemen will really be, to me, the biggest driver for dollar yen going forward. And again, for the reasons I've related, I'm very skeptical of calling for any sort of huge gains in the yen. If anything, I think the dollar's really come under a lot of pressure over the last couple of months as markets got so pessimistic about the U.S. economy, so dovish about the Fed, and we're just starting to see that repricing. We had that trade was basically kneecapped last Friday with that jobs report, gangbusters report. Yes, we've got one more jobs report before the November FOMC. Yeah. But it's clear the U.S. economy is head and shoulders above everyone else in the world, and that's why I'm so strong. Dollars positive.
I am curious. You mentioned the next jobs report. I am curious that between now and then here, I mean, what could potentially be the next catalyst, at least based on what we already know is on the calendar for that yen trade?
Yeah, it's well, we've got again, we have to look at both sides of the coin. We've got earnings data, cash earnings data for August out overnight. Bank of Japan is very fixated on sort of the wage price dynamic. So the things that on the Japan side, data such as that, orders data out of Japan have been very soft, again, pointing to weakness ahead. For the U.S., we've got CPI and PPI later this week. And then, the sort of the usual suspects. But, it's again, I think that next jobs report is really the key. I think it's November 1st. And yeah, it's an eternity between now and then. But I think until we see any evidence otherwise, I think it should be hard to stand in the way of this sort of strong dollar recovery at this point.
Yeah, well, we'll have to make do with a lot of other data points, including inflation on Thursday. Win Thin, Global Head of Market Strategy at Brothers Harriman, thank you so much. Coming up, we're going to stick with Asia and talk about China stocks, poised for further gains when mainland markets reopen this evening in just a couple of hours. Shehzad Qazi of China Beige Book International will be joining us next to discuss. This is The Close. Optimism running high as traders gear up for China's onshore markets to reopen after a week-long holiday. The Hang Seng Enterprises Index jumping 11% since the Golden Week holiday kicked off last week. Shehzad Qazi, Managing Director at China Beige Book International, joins us now. Shehzad, great to see you here. You write in your latest note, is this China's Draghi moment, where basically the government official, in this case, Team China, says they'll do whatever it takes. Did the stimulus measures that Beijing announced qualify as a whatever it takes moment?
No, absolutely not. This was not a whatever it takes moment. The important thing for investors to understand is that we don't need a whatever it takes moment in China because the Chinese economy is not in a crisis. All year long, what we've seen is a slowdown in economic growth being confused for all-out economic catastrophe because I think expectations were completely unrealistic and unhinged.
Well, it gets to this idea, though, too, as to if a market is anticipating this. And I know, look, the China market is a lot different in terms of can't really push back on the government the way you can here. But if you have a market that now seems to be all in on this, at least for right now, does that not potentially sway things, or is that just not how it works?
I don't think so. Look, we've had a lot of folks saying stimulus for the better part of the last 3 years, if not more, and the government simply hasn't delivered because the aims of the Communist Party or President Xi are very different from what market analysts and investors are looking for. We've seen a bunch of sort of face-ripping rallies take place, and then what you have is a crash right after. So I think they are committed to their goal, which is much more national security focus and much less making Wall Street happy.
So the goal here by Chinese officials, was it to boost consumer sentiment? Was it to lift the equity market? What were they targeting for specifically here, and did they accomplish that?
I think the broad goal is you put a floor under the economy, you put a floor under sentiment, because you don't want further degradation. The goal is certainly not to get some kind of big outsized GDP number or to have some kind of multi-year stock market rally, or worse yet, to reinflate the property bubble, which I think is probably one of the least understood aspects of what's being talked about lately.
I am curious about the presence of foreign investors, and we've seen a lot of activity by non-Chinese investors in this rally. I know China, at least publicly, will say we don't care about them. Do they need those folks?
They would love that money, and that capital is going in the new economy, right? It's semiconductors and chips and cutting-edge advanced technology, and that's where American and other Western investors want to be. Of course, that raises a lot of geopolitical tensions, and D.C. wants to crack down on that. At least some folks in D.C. do. So it's fraught with political risk, but certainly I think the party would welcome that.
Where does it make the most sense for foreign investors to go into China? Because there are so many choices in terms of, an ETF that just gives you exposure to U.S. listed Chinese stocks, or maybe there's a new ETF called DRAG, which invests in the equivalent of what the issuer calls China's Magnificent Seven, these 8 stocks that really highlight China's innovation and technology industry. How would you go about it?
I think, the place to go is putting aside the national security sensitive sectors, priorities of the Communist Party. They've got an aging population that you need to do something about that. Those sectors, I think, are going to boom. I think they want to have more and more families, people to have kids. Sectors that are supporting childcare and education, I think those are areas to go. So I think aligning yourself with what the party's priorities are is going to be a lot more fruitful than anything else.
So we're not going to see that big infrastructure fire hose of cash that we saw in past economic cycles. You don't think that's a possibility?
Look, them handing out a bunch of cash to households, I don't think it happens. We'll all be positively surprised if that's what they announce tonight.
All right. Well, of course, the markets around the world will be tuned in exactly to see what happens. And of course, course, mainland investors will get their shot here at participating in the rally, or maybe not. Shehzad Qazi, managing director over at the China Beige Book International. All right, we do have some breaking news. This on Penn Entertainment, I should say, the gaming company, out with preliminary results. The share is moving higher in after hours trading as the company says the third quarter adjusted earnings will come in a range of $465 to $475 million. Now, it should also point out that the company is saying that its earnings have been hurt by lower betting volume and weather, and that could have a little bit of an impact on its interactive business here, with the loss there on that business at 90 to 100 million, though a narrowing of that loss here. Scarlett, they don't actually report, though, until November 7th, so we got about a month here for this split to play out.
Okay, yeah, this is in the South, in particular, those severe weather disruptions and hotel remodeling. But of course, Penn Entertainment, along with all these other gaming companies, have been doing really well with the advent of sports betting and the legalization of so much of that across U.S. states.
Yeah, still shares higher here in after hours trading here, so I guess investors like what they heard.
All right, coming up, from a small business in New Jersey to making a mind-boggling $100 million in sales. We're going to catch up with the CEO and founder of the popular Bogg Bags. Have you ever seen one of these?
Only on TV, so it'll be interesting to see one in person here. Are these for men too?
You can always pick one up.
I guess so, yeah.
This is The Close on Bloomberg. Only a few more hours until Amazon's October Prime Day kicks off. Amazon is set to offer Prime members exclusive deals during this two-day event. And this is happening as Target is running Circle Week in a move to compete with Amazon. For more on what we can expect from this Prime Day, I want to welcome Poonam Goyal. She is Bloomberg Intelligence Senior U.S. Retail Analyst. Poonam, will there be any disruptions from the three-day strike, what ended up being a three-day strike at East Coast and Gulf Coast ports? Because certainly before that was resolved, that was going to be a big issue about whether people were going to get the stuff that they ordered in time.
I don't think there should be any disruption for Prime Day on that, because much of the inventory was likely already at Amazon warehouses ahead of the strike. So we don't foresee disruptions. And because the disruption was just 3 days, I don't expect it to no longer disrupt holiday either.
Okay, gotcha. And, when we talk about Prime Day, this was kind of an invented sales event that Amazon came up with to kind of goose sales during slow summer months. The original Prime Day was in July, but it's also introduced these October Prime Days. What's the difference between the October Prime Days and the original July Prime Days?
So the October Prime Day is essentially to pull forward holiday spend. So traditionally, people are shopping for holiday gifts around Black Friday, right? Because that's where the big deals kick in. But Amazon launches this October Prime Day, which essentially takes money from people in advance. So if you have $500 to spend on holiday and you spend $200 in October on Prime Day, that leaves you with $300 to go.
Okay, got it.
So Amazon's pulling forward that spend.
And it's forcing everyone else to do the same, as we mentioned with Target Circle Days. What tends to be popular then during October Prime Days versus the July Prime Days, the traditional July Prime Days?
So you get a little more gift shopping being done in the October holidays. The top categories are still apparel, beauty, and footwear. But that said, you'll get people shopping for the home, you'll get people buying toys, you'll get people buying gifts. It's a little bit of everything on this Prime Day.
Okay. I guess this is something that always comes to mind. Whenever Amazon has these big events, how much does it really disclose in terms of the sales that it books during these big sales events? How much do we really glean from that? Or is it just kind of tallied up at the end of the quarter and we know that there was a Prime Day event held during that period?
So it's tallied up at the end of the quarter. They don't tell you the dollar volume that they've done, but they do tell you the number of items or the units that they've shipped, and they keep growing every year. So each year the Prime Day gets bigger and bigger. So we do know that it's substantial, but we don't know the volume that's done.
And with Target and other retailers launching their own version of these sales events, are they taking away sales from Amazon by doing this, or are they only, moving forward their own sales that they would have booked in, December or right before December?
So I think it's definitely a pull forward of holiday spend across all three. But absolutely, when Amazon's alone to have a Prime Day, they're going to capture more. And as others join the party, they will lose some to others.
All right, Poonam, thank you as always. Poonam Goyal of Bloomberg Intelligence covers retail and e-commerce and giving us a rundown of what we can expect from Amazon Prime Day. Now, Amazon merchants can make anywhere from $1,000 to $100,000 a month selling their items on the e-commerce hub. Sales for one of 2024's hottest accessories, the Bogg Bag, are expected to reach $100 million this year. Starting at $70 for the miniature version, Bogg Bags have inspired a cult following from mothers and caregivers looking to stay organized and stylish. Here in studio with more on its rapid rise is Kim Vaccarella, founder and CEO of Bogg Bag. Thank you for coming in today.
Thank you so much for having me. I appreciate it.
So the Bogg Bag is a resounding success in the last 3 years, but you actually first prototyped this product back in 2009, and it was something that you designed even though your background is not in fashion or in design. What was your idea and what was your pitch to the industry?
Well, you know what? I didn't even know what a pitch was at that point. So I just knew that I needed this bag made of this material to carry everything that I needed for a long day at the beach. On the Jersey Shore, we're on the beach from morning until dark. Mm-hmm. So you have to carry all the things all the time. I also had two sons that were very active in sports. So making sure that we were able to carry everything and that it was washable at the end of the day were super important to me.
And the material that you talk about is EVA. It's
Yes.
the same material that's used in Crocs shoes,
Yep,
right?
it's a very similar material. Great thing about it is it's antimicrobial, it's washable, it's durable, it's sturdy. So all the things that we need as moms to carry all the things.
Did you ever talk to Crocs about this? Because it would make sense to kind of go to them.
Right. You know, I reached out to a lot of people early on. I got a lot of resounding no's, a lot of it's too utilitarian, it's not going to work, it's too big, no one will ever need more than one. So I had to take all those no's and turn them into yeses.
And you did that largely on your own, right? You drained your savings and moved forward with ordering a shipping container full of the bags.
Yes.
But the manufacturers messed up that shipment. You ended up with damaged goods.
Yes, the color was great, the functionality was great, but it had black marks on it, and I knew I had wanted it to be able to go into high-end retailers. I mean, and that was only a dream at the time, but I stuck with that, and I said, I can't sell these. We ended up donating all of them to Sandy victims on the Jersey Shore. Filled them with supplies that they would need as they entered their homes. Mm-hmm. They were dealing with molds and all of the issues that they faced. So we were able to get a bunch of donations and fill up these bags.
And that's what kind of set it off because people realized how functional these bags were,
Right.
and they started contacting you about how they can get more of them.
Yeah, absolutely. We had a Facebook page set up at the time, letting people know where we would be with these donations. Mm-hmm. And about 6 months to a year after Sandy, when people started rebuilding, going back to the beach again, then they were coming back on that Facebook page and saying, hey, where can we get more of these bags?
So the bag has gone viral. I think there's over 170 million posts on TikTok.
Yes.
It's really part of this cult economy. Does it worry you that you've created something so popular because at some point the crowd will focus on something new and shiny and kind of, stray away from your original product? How do you keep this going? How do you sustain this?
Well, listen, the way I think of it is Stanley, right? I mean, there are 80 million water jugs out there right now. Stanley has been a beloved company for years and years and years, and they can do this. I think Bogg Bag will be the next one that can be a generational company.
Well, I mentioned Crocs earlier. Does it worry you that Crocs might want to come out with its own version of accessories using EVA material and kind of pick up on what you've done because you've proven there is a market for this and there's a demographic that wants this product?
Right. Listen, we've done the best we can. Most of it was organic and grassroots. Mm-hmm. We've built relationships with our customers and our retailers, and we hope that carries us through to the next phase of the business.
Let's talk a little bit about those relationships with retailers. You started off direct to consumer, but it's now available in about 4,500 stores like Dillard's and Dick's Sporting Goods. How do you get past the idea to them that this is more than just a seasonal product? You mentioned originally it was for if you go to the Jersey Shore and you're going to the beach, for outdoor use.
It originated as a beach bag, but what we found so quickly was that it was so much more than a beach bag, right? Mm-hmm. Moms were using it to go to the soccer field, to go to swim school. They were carrying it, nurses and teachers were carrying it, especially over COVID, because of the antimicrobial material.
Oh, right.
Yeah, they weren't allowed to bring canvas and leather into the hospitals and into the schools. So it became a great tool for them to carry all of their things and be able to wash it out at the end of the day. So we've kept this year-round thing going with Bogg Bag, and we just keep bringing out more things to help them organize throughout the year and not just at the beach.
Including accessories that go on top of the bag or outside of the bag.
Right.
Talk a little bit about kind of that sub-economy that goes along with it, because it's not just you. Other companies have come out with products for it too.
Well, accessories are king right now. I mean, anything that you can accessorize, and we've seen it on the highest end products to the lowest end products. Anything that you can decorate, accessorize, customize has been so big. And we just want to be their one-stop solution for all of those things.
What is next in your product lineup? How are you thinking about building on this brand recognition? And, is it going to be staying with the EVA material, or are you looking past that?
We're actually staying with the EVA material because honestly, it just lends itself to anything that is outdoors and fun and joyful and colorful. So we're really staying with that. But what we're doing now is becoming the organizational tool for moms on the go, for teachers, nurses, for anybody on the go, quite frankly. And we even have men that are using it too.
Men who are using it. Romain will be excited to hear that, because he was asking about that earlier.
Yes.
You had mentioned that this is something you had gone to different companies with, and you heard so many no's. Did anyone reach out to you after the fact, now that it is a thing and now it is all over TikTok and popular?
Yes, just saying I'm so sorry that I didn't invest in this earlier, right? I mean, everybody is thrilled for our success. It's been great. We've kept all those relationships.
Yeah.
So those people are now rooting for us, which is fantastic, which a lot of times you'll get the reverse. But we've just maintain those relationships along the way.
And when you first started the Bogg Bag, you were in commercial real estate. So you were in an industry completely separate from what you're doing now.
Right.
When did you feel confident and comfortable enough to quit your day job and focus on this exclusively?
It took a while. In 2018, so we came back on the scene probably in like 2015, started going to the trade shows in 2016. It just got a little bit bigger each year, and there was two of us working. There was my husband was helping, but I had one other girl, Julie, who's been with me since day one, and it was the two of us running over to the warehouse at night to pack bags after I would work all day. 17 got a little busier, and then 18 it got too much. Trying to do everything with the family, run the business, and work full time. So in 2018, I retired in July and ended up leaving around October.
Okay, so it took a while, but you did it.
It took a while, yeah.
Kim, thank you so much for joining us today.
Thank you so much for having me. I really appreciate it.
Kim Vaccarella is founder and CEO of Bogg Bag. All right, let's transition back to the public markets and see how they closed on the day. The S&P 500 finishing a down day here. Good economic news on Friday was good news for stocks. Not the case on this Monday, losing 1% in trading today. And of course, the repricing in the bond market continues, with yields on the 10-year pushing up by 5 basis points to 4.02%. Crude oil extending gains to a fifth day, up at $77 a barrel. And we are awaiting the reopen of Chinese markets after a week-long holiday. Right now, by all indications, it is going to be a higher open. This is The Close on Bloomberg. Wall Street is printing new ETFs at a much faster pace than just a few years ago. Retail investors are now plunging into the complex world of derivatives-powered ETFs that often promise huge payouts, and pros and regulators are urging caution. This is Bloomberg's Big Take, and for more on the story, we're joined by one of the reporters behind it, Denitsa Tsekova. Denitsa, great to see you.
Pleasure to be here.
So the ETF that kind of invented this category is known by its ticker JEPI, the JP Morgan Equity Premium Income ETF. It doesn't really sound all that sexy, but the basic premise of it is what? You can make money while you wait for markets to recover?
Exactly. It doesn't sound that sexy, but it came at a time. So it came in 2022, but in 2021, we had that terrible bear market. Everything was down. There was nowhere to hide. So investors found a covered call strategy that provided some shelter in this type of bear market. And along with providing some shelter, it also offered income payments. which is where this craze started, right? Initially, the payments were like 7-8%. This is what JP pays. But then we have some new issuers taking this to a new extreme. They're saying, what if we do that strategy on a single name? What if we do it on Tesla? Then the yield becomes 100%. If you do it on Coinbase, it's 160%. Obviously, there are so many caveats with that. But it started a whole movement of people who don't care so much about total return, but they care about how much yield they get. And they care about monthly income, passive income, and it's a totally different type of investing than what we usually think of.
Right. So it's like they're getting payouts regularly, almost like a dividend, but a supercharged dividend.
Exactly.
But at some point, they need to exit the investment, maybe. And when they do, is the ETF price, the stock price, essentially going to be similar to what it was when they bought it?
Well, a lot of those investments, like if we look at some of the popular ones that track Coinbase, Tesla, a lot of those actually underperform. And obviously, if it has a rough patch, then they may have losses. But the strategy is not to take care of that. It's actually to get the monthly payments and invest into other stuff. It's a really big community on Reddit, YouTube. It's reminiscent of the meme craze days, but of course, a lot of those strategies have a defensive tilt. But it's interesting how issuers are really going straight to those people, straight to those YouTube channels. They're doing like 50 minutes interview, and they're interacting with retail and telling them there is this whole new world of options CTF, of derivative CTFs, and they're perfect for you.
Right, but they're also not giving them all the caveats either. And for that, you did speak with someone at the SEC to look into how they're thinking about this. What did they say to you?
We indeed spoke about the SEC about that, and they were quite worried. They were quite worried that there is so much complexity. We looked at the launches. There are record launches of this derivatives product this year. And this all comes as retail is super active. Retail traders are on Reddit, YouTube, TikTok. They're consuming all of that. And, you know, if you look at the filings, there are long disclosures. There is all of that. But there is the question of, are retail traders reading all of that? Do they understand all of that? And, you know, they're so complex. Like, it's really hard to figure out what they do in bull market, in bear market, in a sell-off. So it's really hard to predict.
Yeah, everyone's just scrolling past and clicking the OK box at the end of the day. Denitsa, great story. It is the Bloomberg Big Take. Denitsa Tsekova on all these income-generating derivatives-based ETFs. Let's go now to the top three, where we name drop the people driving some of the day's most talked about stories. And first up is John Kerry. The U.S.'s former top climate diplomat and Secretary of State is joining billionaire Tom Steyer's sustainable investing firm. Kerry will be co-executive chair of Galvanize Climate Solutions, which invests in VC, real estate, stocks, and other assets. He'll focus on expanding the firm's strategies and inform how technology, policy, and geopolitics are shaping that shift to clean energy. Next up is Stephen Scher. The former Goldman Sachs CFO is returning to Wall Street starting this week. He will be co-president at Pretium. It is a major landlord of U.S. single-family homes. Scher left Goldman in 2021 to run the car rental giant Hertz until this past March. And third on the docket, Bronny James. The LA Lakers celebrated his 20th birthday by sharing the basketball court with dad LeBron James. They marked the first father-son pair to play together in an NBA game, or more accurately, preseason game. The Lakers lost 118-114 to the Phoenix Suns, and Bronny was unable to convert on a father-son assist, missing a three-pointer off a dribble handoff from LeBron. And those were your top three. Now, still ahead, what investors need to watch for over the next 24 hours. We'll get you caught up. This is The Close on Bloomberg. Boeing and its largest labor union resuming talks to end a 3-week strike. This ahead of the plane maker gearing up to announce third quarter deliveries expected tomorrow. Joining us now is Thomas Black of Bloomberg Opinion. He covers manufacturing, aerospace, and logistics. Thomas, let's start first with the production numbers. And because of this strike, I'm thinking, or I'm expecting that the numbers will reflect that, there hasn't been any production.
There will be and a reflection in September. The number will go down. You have to remember the strike started about mid-month, the 13th of September, so they had those numbers in there. And then there are some planes in inventory that they can deliver from, but those will quickly dwindle. And we also, the interesting thing is for the quarter, the deliveries might actually be up this third quarter from last year, just because July and August were fairly robust, and then we had that decline since the second half of September.
Yeah, interesting, especially even though you've had all those incidents, the safety incidents at Boeing, that the numbers would still be up for the quarter. Given all of that, where do things stand with the strike? We mentioned that the two sides are coming back to speak to each other, but I remember the days before the strike actually began, there was a lot of talk that, oh, this will be resolved in a week. This will be a couple of days at the most, and that has not turned out to be the case.
No, it hasn't. It seems that the workers are much more angry, perhaps, than the market and maybe even Boeing expected. So they're back to the bargaining table. There's a federal mediator that's helping lead the talk. So we'll see if there's movement forward. The fact is that Boeing is bleeding cash, and this strike doesn't help that situation.
No, it doesn't. And it has a new CEO, Kelly Ortberg, who was brought in, and it was thought that under Kelly Ortberg that he would want to get things moving and kind of reset the plane maker on a more sustainable track. And that hasn't happened. Does he, I know that he doesn't necessarily have leverage, but what is he not doing right here? Or is it a matter of getting, the two sides to come to a number that they can agree on?
Well, that's interesting because he came in when the talks obviously had been going on for a while. It's unclear how much of an active role he took in the talks at first. And reading between the lines from the union, perhaps certainly not as much as they would have liked. So it's going to be interesting to see if he takes a little bit more direct action in the talks and try to move this thing forward, because he has to resolve this and start producing planes. They need the cash flow.
They need the cash flow. Is the government, whether it's the FAA or the White House, going to intervene in any way? What are you hearing?
I don't think so. Certainly on the port strike, we didn't see the White House intervene with the Taft-Hartley Act. They were on the bully pulpit side for sure, but so they had a policy of no intervention. So I don't see them intervening in this one either.
Yeah, and we've seen Boeing shares kind of just stuck in low gear for a while now because of all the safety issues. Once they do resolve this, do you anticipate that it'll be reflected in the stock, or is that something that it's going to take a lot more to get it back on track?
Yeah, I think that's one of the first pieces of the puzzle that needs to go into place. They have to resolve the strike, and then there's the big question of repairing that culture within the factory and within the company, really, to start producing planes with quality and get those rolling out. That's a big challenge. So they have to get this first step first, and then it's going to be also a kind of a wait and see. Can you crank up production? Can you get the FAA to validate what your processes are, and then uncap you from those 38 a month on the 737 where they're at now? They're not anywhere near obviously producing those planes, but in the future they need to produce north of that number.
All right, Thomas, really appreciate your joining us. Thomas Black of Bloomberg Opinion, covering manufacturing, aerospace, and logistics. And of course, it doesn't just affect Boeing's finances, but also that of its suppliers. Let's look ahead to what else we're watching tomorrow in addition to those Boeing production numbers. In the pre-market, we'll have PepsiCo reporting earnings, the soda and snacks giant coming out with its latest results. And then in terms of eco data, the NFIB small business optimism, that comes out first thing in the morning at 6 a.m. Eastern time, followed by the trade balance at 8:30 a.m. That typically doesn't move the market as much. We do have a lot of Fed speak scheduled for tomorrow. Kugler, Bostic, Collins, and Jefferson. Of course, a lot of it is going to be dependent on, or what the Fed does next is going to be dependent on what the CPI and PPI data look like later on this week. And Amazon Prime Day begins. It's a 2-day shopping event, and voter registration deadlines in Illinois and New Mexico take place. That does it for us. Balance of Power is up next. Have a great evening. This is Bloomberg.